Alright, so there's a ton of things that happened to the economy this week. A new report just came out about the main lifestyle of Americans, and 62% of the US is now living paycheck to paycheck. Also, the US debt is getting worse, US spending is out of control, inflation is still too high, and the new interest rate was just revealed. But first things first, let's talk about inflation. It's how the government measures how fast the speed of prices is going up.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
Now, before I unpack this,
Do me a favor and smash that like button for Andrei's video so we can inflate his view count like the Fed inflated inflation.
that's just how I like to use AI. I have become Fed, the destroyer of worlds. Now, so far, of course, we know that the price of stuff we buy is not coming down. And the most important one that everyone is waiting for is shelter. Things like rent. And that went up 0.6%. And it's not just rent, it's literally everything else as well, including energy, food, and gas prices. So all in all, when factoring in any pay raises that someone might have got at their job, thanks to inflation, their real wage growth was negative by comparison. So it looks like prices aren't coming down, and they probably never will unless we get another round of layoffs or a recession. The only good news about inflation is that prices are growing at a slower rate, closer to what the Fed actually wants, which is 2%.
We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. And the full effects of our tightening have yet to be felt.
Next up this week is the interest rate, specifically the federal fund rate, which is the cost for banks to borrow money from each other. And this week, the Fed got together to decide what they were going to do, and the new rate is going to stay exactly the same, which is also why the stock market went up this week. And I'll explain why this happens later in the video. But arguably the worst news is that the US is spending money out of control, and it's borrowing to do it.
But we are spending like drunken sailors, okay?
So let me explain exactly what's going on, and let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the breakdown. I'm going to talk kind of slow in today's video so you can hopefully understand what I'm trying to explain, because it's about to get extremely complicated. Now, you might have seen this article recently that the 60-40 just had its worst year in generations. And that sounds terrifying. So what the heck does that mean? So when our parents learned about investing, they learned about something called the 60-40 principle, which taught them that for every $100 they had invested in their portfolio, 60 of those dollars should be put into an ETF like VU, which represented the stock market's S&P 500, and the other $40 would be placed into bonds. That way, when the bond market was down, stocks were up, and when stocks were down, bonds were up. Hopefully this volatility would balance itself out. It was there by the dip strategy. But that strategy just had one of its worst years ever, and why this happened is a really good question. Now, the short explanation is bad timing. But the long explanation, I'll let Papa J. Powell take over and explain what he's doing to interest rates right now.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
So Jerome Powell says that they are still reducing securities. So that's the bad timing part. So what this means is, remember, because of the pandemic, we flooded the economy with trillions of dollars in stimulus. They did that by buying specific assets, and that was called quantitative easing. But that created inflation. So now they're doing the opposite. They're doing quantitative tightening. And the way they do that specifically is by selling off two assets out of their portfolio. And that's treasury bonds and mortgage-backed securities at the rate of $95 billion a month. But what the heck does any of that mean, and how does that affect us? It affects us because, think about it like this. What happens when someone is a net seller of something they control a lot of? That something goes down in price. So when the Federal Reserve sells its bonds out of their portfolio, it lowers the price of those bonds, which is exactly what we're seeing happening to the bond market. It's losing a ton of money. What this means for the rest of us is that the cost of buying a new car, or buying a new house, or opening a new credit card, or pretty much anything to do with borrowing money has gotten really expensive, which is also why our debt levels are pretty much near record highs. Therefore, hopefully discouraging people from going out and spending more of their money, lowering inflation. And that's the theory behind it. But the second thing that happens is that corporations can't borrow money either. So they play defensively, stocks go down in value, layoffs start to happen, and that's not very good. So now you have this perfect storm where stocks will go down in value, and because the Fed is selling off their bonds, it depresses the bond market as well. So that's why this seesaw is completely broken, and that's the long explanation of what the 60-40 principle is based on and why it had its worst year in generations. So I hope all that made a little bit of sense. It was just bad timing. Thanks to the pandemic, we created stimulus, which created inflation, so the Fed had to raise rates to fight inflation, which is great for bonds, but not good for stocks. And then the Fed eventually had to sell off their bonds, which isn't good for bonds, to drain the liquidity, and that's where we are today. If that didn't make any sense, just press the J button on your keyboard to go back 10 seconds a couple times, and you'll still probably be confused. Now let's talk about what's happening this week, because the Fed paused interest rate increases. And that's why you're seeing articles like this. The stock market is rallying, it's going up. And why this is happening is because the stock market's like, thank you for slowing down our competitor. If you keep raising rates, there's no reason to invest your money in the stock market when you're guaranteed a 6% with bonds. So that's why the stock market is excited and why it's going up. Now, the second thing that's happening is why you might have seen articles like this, encouraging you to buy into the bond market because it's about to go up. Why are these companies doing that? How do they know? Do they have a crystal ball? Are they shills for the government? No, the real reason why they think bond prices are about to go up is because anytime the Fed stops raising rates like they just did, and like they did way back in July, they haven't raised our rates, that at some point it makes sense that they'll start to lower interest rates. Well, when the Fed lowers rates, bond prices do go up. And here's how it works. Here's how you can think about this. Let's say that you buy a bond today that's yielding 5% interest and it has a maturity of 3 years. So after 3 years, you get all your money back plus the interest. Well, let's say you buy this bond and you hold on to it for 2 years. And let's say in 2 years, the Fed will have already lowered its interest rate to say 3%. Well, now your bond that's paying 5% has a premium on it. If you were to sell that bond on the secondary market before that maturity date, then you would get more money than what you initially paid for it because it's paying a higher interest rate. And that's how this mechanism works of whenever interest rates go down, bond prices go up. And that's why people speculate that right now is the time to buy into these bonds because their prices will go up because the Fed will lower rates. Now, I did simplify this a little bit though, because there is a difference between bond funds and individual bonds, but we'll skip that part. So then the question is, when will the Federal Reserve lower interest rates? And that's the million-dollar question that no one knows the answer to. But the theory is sometime in 2024 or when we go into a recession because they'll have to lower rates to pull us out of it. But for now, there is one more potential rate increase this year. The next time we'll find out is December 13, 2023. But so far, the odds are in our favor that the rates will stay the same. But it can also change as we get closer to the 13th. Now, what I think is kind of funny though, is that if you say interest rates are kind of high right now to someone who was alive in the 70s and 80s, they'll be like, "Ah, you young whippersnappers. Interest rates were way higher back when I was younger." And that's true. Interest rates 40 to 50 years ago were in the double digits. But the difference between now and back then is that back then, the national debt didn't look like this, and the price of a starter home didn't look like that. And when you combine what's already a highly valued market with our current debt and our interest rates, you get a country that needs to borrow money to pay for all the money that it's borrowed. It's like imagine taking out a credit card to pay for all your other credit cards. If the US was a person calling in to Dave Ramsey asking what it should do, Dave Ramsey would be losing it right now. He wouldn't have it. He would be telling the US to get on rice and beans.
No. You have a crisis. No. You are on beans and rice and beans. No vacation. You will not see the light of day. You will work like an animal.
Because here's what happened recently that I didn't see a lot of people talk about that's kind of a big deal. The US Treasury borrowed $776 billion in the last quarter of this year, and they're expected to borrow over $800 in the first quarter of next year to pay for Treasury things. And Treasury things are things like paying the interest rate on Treasuries. Because think about it, when you earn interest from a bond, who pays that interest? It's the Treasury, which now has to borrow money to pay its investors. And if the government is running on a deficit, if it's spending more money than it brings in tax revenue, it has to borrow money to pay us back. So we really are spending like drunken sailors, which is ironic considering it's coming from a drunken miller. I'm sorry. But the point I'm trying to make is that when the US borrows money, it does that by creating bonds. That's why we're at a record high in issuance of bonds, because we're borrowing at a record pace. And the problem with borrowing money is that we have to raise interest rates to entice more bond buyers. And when rates are high, it can drown out innovation and destroy the stock market. And why would companies borrow money at these interest rates? And why would we risk our money in the stock market when bonds could potentially pay us even more? It's a perpetual problem, and I don't think I'm smart enough to figure out where this problem eventually leads, but I don't think it's a good thing for either consumers, investors, or the country as a whole. But I'm probably wrong and I have no idea what I'm saying. I'd love to know your thoughts though. I love macroeconomics. I think it's so complicated and so fascinating, and I don't fully understand it, but the more I learn about it, the more confused I sometimes get. So hopefully together we can get unconfused, one video and one smashing of the like button at a time. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with a spreadsheet linked down below in my Patreon. Love you, thank you so much for watching this video. I'd love to see you back here on Monday and Friday, sometimes a Wednesday. See you soon, bye-bye.